Well, how's it going, friends and family? My name is Amos. Welcome to episode 9 of the Cheese Public Portfolio series. In this video, I'll be going over some major additions and subtractions from the portfolio itself, a quick lesson on sunk cost fallacy, and then I'll go over an important life lesson at the end of the video. And by the way, the portfolio has transformed drastically. It's not even a haircut. It's going from being bald and putting on a toupee. It looks completely different from the portfolio that you guys witnessed in episode 8. So as an overview, let's take a look at the portfolio. The total P&L, $41,700. Total return, 287%. The IRR, basically, not really, but in a similar vein, the CAGR is about 33%. The dividend yield, 1.8%. If we were to round up, 1.9%. And I'll leave my mouse here as we talk about numero uno. First and foremost, I did it. With a heavy heart, it was really difficult, but I sold the trade desk. Ticker symbol TTD. Now, from the beginning, I made it clear that the trade desk was never a long-term buy and hold for me. And the reason being is that advertising is inherently cyclical, so the plan was always to swing trade the position, to buy the dip at around $40-something a share, and then to sell out of it at about $52, $53. Obviously, that did not pan out. And unfortunately, that's because the core thesis shifted radically to the downside as Amazon and Google ramped up pressure on their market share of having advertisers spend their finite marketing budgets on Amazon and on YouTube and on Google search instead of the open internet, the trade desk. And to make matters worse, if we pull up the trade desk's numbers on stockanalysis.com, by the way, I have a referral link that'll give you 10% off if you're interested in signing up for this. So let's take a look at this, right? So when I initially bought into the trade desk, it was after this dip right here towards the end of 2025. And I kept thinking to myself, there's no way they're going to go lower. Boy, was I wrong. Because after I bought into them, they went further into the red by 67%, which was my loss, by the way. Currently $13 a share. You pull back the timeline, for all we know, the trade desk is headed towards their IPO price of about $2.76. But I digress. As we jump on over to their data and their numbers, the P&L is the first one that I want to talk about, and not on an annualized basis, because look at this. Their revenue for the past 90 days, it only grew by 3%. That's a major drop off from what they were usually executing, which was what, roughly 20+%? And it just kept going lower and lower and lower by the quarter. Now, on an annualized basis, you can see that when the times were good, advertising budget, the revenue went up 43%, and then 31%, and it's just slowly declining. The worst part is, major advertising agencies, they have severed their ties to the trade desk, and they're doing business relationships with the trade desk's competitors. So do I see this being a temporary dip in their numbers? No. I think this is a catastrophic shift in their economic moat and in any competitive advantage that they were clinging on to. And so as I see the numbers dropping like this, for me, that's a major red flag. Because as you take a look at the profitability of the company as well, it is dropping quarter after quarter, negative 20% in Q1 of 2026, and then negative 24% in Q2. So the business fundamentals have declined. It's getting ugly. And to make matters worse, their balance sheet, it's getting worse and worse. Their cash position is only declining, while at the same time, the amount of loans that they have to their name, how leveraged they are, it's getting worse and worse. As you can see, $300 million of debt, and now it's $434 million. That's not the trend that you want to see. You want to see it be steady or to be in the decline. But to see the amount of loans increasing, another red flag. And we can do this on and on about all of their metrics and numbers. It points, the evidence says that it's getting worse. and their future does not look bright between you and me. And so as much as it pains me to do it, enough was enough. I sold the trade desk for a fat loss. Now, don't get me wrong. If this entire situation, it was just normal stock market volatility and the numbers were pristine and beautiful and they were going on a sell-off, then I would have just held on. Scout's honor, I'm not joking. But seeing as how the numbers are decreasing and their economic moat is dissipating, I had to do it. So referring to my track record, this is not good. I sold at a loss my food stocks, such as Conagra, Flowers Foods, and Hormel, but now also the advertising platform, the Trade Desk. So don't you ever think that I'm a genius or that I'm the next Warren Buffett or that I'm always right. I'm not. Even though the numbers are still in the green overall, I do get it wrong sometimes and I do lose money. It's just the reality of being an investor of the stock market. You can't always be 100% correct, unless of course you dollar cost average into the S&P 500 because of your 401k or if you are a passive investor. But I think the bigger question is, why? Why now? Why not just hold on until the trade desk bounces back, if it ever does? Well, friends and family, transitioning to the next topic. So for my undergrad, I majored in psychology, which is to analyze and to understand the human behavior, but more importantly, the human mind. And there's a concept in psychology known as the sunk cost fallacy. And that's when you have invested a lot of time, energy, or resources into something like a job, a relationship, or in this case, a stock, and it's not working out, but you stick with it anyways because of how much time, money, or effort you have already invested. That hole just gets deeper and deeper, and you refuse to admit that you're wrong or to pivot or to tap out. Now, I personally know stories of folks that stayed 5 years longer in a relationship than they should have, knowing full well by year 2 that they were incompatible, but they stayed together anyways because of the sunk cost fallacy. Whereas had they just parted ways in year 2, they would have saved themselves 5 years in the future. But because of the sunk cost fallacy, they stay together, they argue, they bicker, they hate each other, they resent each other, and then they divorce by year 10. Or they just stick together and suffer with each other. But anyways, by recognizing that I was holding on to the trade desk without objective data to show the bull case was actually playing out, I took the loss and I moved on. Because the initial investing thesis was that the online streaming platforms like HBO Max, Apple TV, Hulu, Disney, ESPN, they were not going to fork over their proprietary customer data and advertising budgets to their competitors, Amazon, Google, YouTube, but instead a third-party advertising platform, the Trade Desk. I think it's pretty simple to understand, but in the end, the companies just went with Amazon and Google anyways, because they were undercutting the trade desk and offering their advertisements to be placed in strategic locations at a fraction of the cost as they waited for the trade desk to die by 1,000 tiny paper cuts. The advertising world is pretty darn cutthroat. I know because one of my MBA classmates that was in my learning team, he came from an advertising background, and I feel silly that I was betting on the small fish that's playing against the big dogs. So another learning lesson is that if I know a company or an operation is up against big tech, Microsoft, Amazon, Meta, and they're trying to fight for market share, I'm not going to err on the side of the underdog anymore. I'm just going to go with the big dogs who have more money, more time to lose, so that they can wait for their competition to die and wither away. And the big question that helped me to pull the trigger was, if I didn't own the trade desk already, and I came across it today, at roughly $13, $14 a share, would I want to buy it at its current price and valuation? And after reflecting on it for a bit, my answer was a no. So why would I ever want to hold on to them when I was in the red by a significant amount? I had to let them go. But also another reason as to why I sold them at a loss, opportunity cost. Now this is an investing terminology. Right now, we're in a bull market. And to have my capital tied up in a declining business where the stock price is going red day after day is just not very wise of me. Such as buying into Cisco at the top of the dot-com bubble crash in the year 2000, it would have taken you 26 years to break even. And so understanding textbook and historical examples of that, I didn't want to listen to the voice in my head that was trying to convince me to hold on until I break even. Because for a stock to go from $14 back up to $41, dude, you practically have to 3, 4, 5x. And that's pretty darn difficult. But the good news is whatever money I had left in the trade desk, I actually rotated it into short-term plays that are in the green already. Now, the Patreon community knows exactly which stocks I'm talking about. And so another learning lesson here is I wish I would have sold the trade desk in the springtime when the cracks in the armor were starting to show. But I held on for one more quarter, hoping that there would be a turnaround story or empirical evidence to show that things are up and up. It didn't play out. Because had I just rotated earlier, that capital would have been put to use and growing for me for an additional 3 months. But I guess you lose some and you win some as long as the outcome is income. Shout out to you, Drake. Now, before this episode turns into a 2-hour soap opera, I'm going to speed run the next ones. The next stock that I sold out of the portfolio was S&P Global, ticker symbol SPGI, for a small gain, with the intention of buying back in with a lower cost basis. And that's because I really like S&P Global. It's just, I saw that they were trading in a sideways pattern. Can you see it? Since their initial drop from the SaaS sell-off of February, they have peaks and valleys, peaks and valleys. So I sold out of them at their most recent peak at around right there, $450 some a share. And now I'm patiently waiting to buy back in when they dip a little bit further. I don't like them at 428, because remember, even a very high quality business can be a very bad investment if you overpay for them. And to maximize your CAGR, I want my cost basis to be as low as possible. Because if my S&P Global position, average price per share is like 380 and they jump up to 500 versus keeping it at about 440 and it jumps up to 500, you see the upside between the two differences? That's why I sold out of them. And then I also sold my core positions in Microsoft and SAP, entirely out of them, because the Mag 7, including Meta, Google, Amazon, they've been trading sideways since 2024. Even if there's good news after good news, Microsoft and Meta, they will still sell off the following week. Like they might rally on a single trading day, like 5-10%. And then by next week, they're pretty much back to exactly where they were. And because I noticed that pattern of highs and lows, I capitalized on the gains before they evaporated. Because when it comes to Microsoft, I watched my position go in the green by 50% and then go in the red by 20%, just to go back in the green by 30% and then to go back into the red by negative 20%. And so I was like, you know what? Let me just seize the gains while they're in the green and then I'll buy back in. So the exact same logic and game plan as S&P Global. And of course, SAP belongs in this conversation. I'm going to buy all three of them once again if they pull back and their valuations get a little lower. And then last but not least, this one I'm really excited to say. I love them and I am so glad that I bought into them initially. And that's going to be Abbott Laboratories. Ticker symbol ABT. Let's pull them up right here. My only regret was not buying more shares when they were $82 a share. So I initially started dollar cost averaging aggressively when Abbott dropped from about here to here. So I picked up shares at like 85, 84, 83, and it went gung-ho at around 82. And if you look at what has happened in the past 90 days, 32% in the green. This one was almost way too easy. To see best in class market leaders in the medical device space, to see them go on a sell-off like they did in the springtime, I just wish I would have put maybe 2, 3, 4, maybe $5 grand more into it. But I think that's the greed in me talking, because profit is profit. I walked away a pretty happy camper. A win is a win, so I shouldn't be sitting over here getting all greedy. So Abbott, thank you for your service. Very happy. Now, that wraps up the selling portion. Now, I'm going to reveal the newest position in the portfolio, over 100 shares. And I asked you guys on the YouTube community post, What do you think it could be? And between you and me, y'all almost got it right. Some of y'all said SoFi, some of y'all said Berkshire Hathaway or Boston Scientific, and I think they're all solid guesses. The newest member of the public portfolio series is gonna be MP Materials. My cost basis, $41.46 a share, currently in the green, 45%. Today alone, 9.5%, and so here they are, in a portfolio of 3 holdings right next to the fast food real estate conglomerate, but also consumer staple giant Procter & Gamble. Now, why MP Materials? The investing thesis, really simple. The United States cannot build an independent defense industrial base commercially, but also for the military industrial complex without domestic rare earth refining and magnet production. That's what MP Materials does. So they're very critical for defense, AI infrastructure, including the chips, EVs, robotics, aerospace, you name it. The components all require rare earth elements. In the US, they're spending billions of dollars on MP Materials to be successful. So now you get my drift as to why I was saying I should have sold out at the trade desk a lot sooner so that I could have bought more shares of MP Materials. And by the way, this portfolio right now, only 3 holdings, that's pretty wild, right? And if you're keeping track, the math would say that you are correct, Timmy, because I'm currently building a bigger cash position in anticipation of a market pullback or correction around November, maybe December, as the results of the midterms will emotionally scare investors. You're trying to time the market, you small-nippled freak. Listen, man, it's just what I am predicting. Obviously, my magic 8-ball might be out of batteries, but it's just what I'm thinking. And that's exactly when I plan on buying big, when everything goes 10, 15% in the red. Unless, of course, an undervalued opportunity presents itself in the next few weeks, maybe in the month of September. I mean, it could happen, right? So I'm holding on to the capital, but at the same time, playing into the negative Nancy's in the crowd. If that correction does not happen, maybe I'll just YOLO everything into Nike. Who knows, right? I've been uploading content, video after video about Nike. I mean, as much as we want to talk trash about Nike and their declining and eroding economic moat, it is still a retail and shoe manufacturer that generates $46 billion of revenue. That's funny money. Well, at the same time, I wouldn't say it's my biggest conviction because all else being equal, I would rather go into IBM. And that's because, from my understanding of quantum computing and their role in it, pretty bullish about them. So don't be surprised if IBM becomes a core holding of this portfolio the next time I'm able to upload an episode, which I've been meaning to do for the longest time. It's just with the big move from Japan to the Deep South and then going through my bout of depression and everything, yeah, but if you want real-time updates, I'm pretty active on Patreon because it's so much easier for me to type up a little journal entry and upload it rather than it is to film, edit, and do all the jazz that it takes to upload a video. But yeah, plugging my own Patreon. This video is sponsored by my Patreon. So as you can see, being an active investor that moves in and out of positions, it takes a lot of effort, and that is why I cannot recommend this lifestyle or this tactic to anyone, including my baby girl. For her, I'm just going to have her be a buy and hold passive investor into a few ETFs. And me personally, that's where I'm going to be yielding towards once this portfolio hits $800,000. I want to be more hands-off and put it all into some covered call ETFs and SCHD. But we're still not to that point. So for the time being, active investing, picking individual stocks, it's been working out. But whenever I get too big of a head, I always have to remind myself, hey, what about the trade desk, you loser? What about Flowers Foods, you dimwit? Just to bring me back down to earth. And then changing gears a bit, especially in the investing community, I really hate the idea of, I'll start living my life once I achieve this hypothetical portfolio number or career marker or whatever it is. And the reason why I do not like it is because what happens if you never do? You never achieve it. You get an injury, you get ill, you fail, or the market tanks. You spent your entire life preparing to live once you reach that milestone without ever actually living. Now, I'm not trying to be dramatic here because, to a certain degree, I do appreciate and I support the philosophy of delayed gratification. I think there's a lot of value in sacrificing something today for something that you want tomorrow. Valuable lesson. I agree. But I think there's a big difference between delayed gratification and delayed living. To postpone enjoying your life until a certain goal or dream, between you and me, I don't want to step on any toes. I just don't think that's a good way to live life. And I say that because I made this mistake multiple times in my own life. And the unfortunate reality is that I cannot go back in time and celebrate my victories properly. Because at the time, I was so fixated on the next task or milestone that I robbed myself of the joy I had literally just earned for all of my major accomplishments. College graduation, commissioning, you name it. I was so busy staring at the next peak that I completely missed the view from the top. And it boils down to memento mori, remembering that you will die and that life is not guaranteed. I think every single one of us knows at least one person who sacrificed all the joys in life, put their head down, and saved as much money as possible so that they could retire. They embraced the grind only to get their shins kicked and have their entire retirement game plan derailed. I don't know why so many of us treat life as if it's guaranteed tomorrow. Anything can happen. And so to sacrifice today, yesterday, and the past few weeks for this hypothetical future, it's like, I think sometimes we get so focused on the future version of ourselves that we forget about the person that we are right now. You're never going to be 55 years old ever again. You're never going to be 35 ever again. You're never going to be 21 ever again. And so when people say things like, I'll let my foot off the gas pedal when, I'll relax when I retire, I'll spend more time with my family when work slows down, or even I'll enjoy myself once I finally accomplish this thing. And my whole thing is, maybe that day comes. Hypothetically, though, on the other side of that spectrum, what if it doesn't? And I'm being a huge hypocrite here because I'm a workaholic who thinks he does not deserve good things in life or rest until he finishes the task at hand, and hopefully all of that changes in 2027. But to be clear, I do want to throw this out there because I might not be communicating this properly. You can still be ambitious. You can still work hard. You can still save and invest and sacrifice here and there for your future. But I don't think you have to sacrifice everything about your present life in order to build a better future. Because what's happening right here, it's not some waiting period before your real life begins. Why throw your 30s and your 40s and your 50s down the drain? Why not enjoy the little things along the way? Your hobbies, your family, your interests in life, whatever it is. So, full transparency, I'm in a season of my life right now where I'm actively unlearning that habit for my own sake, but mostly for my daughters. And that's why I'm sharing this lesson with you, because I realize just how freaking important it is. My baby daughter just turned 10 months old. And as her father, I have this responsibility to teach her aspects about life that I didn't know when I was growing up, the stuff that I had to learn the hard way. So I want to show her what it looks like to achieve big goals, working hard towards them week after week, quarter after quarter with delayed gratification without sacrificing the present tense. And to celebrate milestones properly instead of immediately moving on to the next thing like I always did. Terrible. So take it from me, because I have a lot of regret in that realm. But instead of living in regret, It's something that I'm working on in this season in my life as a stay-at-home dad. Because sometimes I catch myself thinking that changing diapers, doing laundry, and taking care of a baby is beneath me. It sucks. It's the ego talking because it's not productive or impressive or utilizing my intellectual capacity. And I hate that I have those thoughts at times, but I'm also human. So even right now, instead of thinking of all of this, my responsibility as a dad, raising her, instead of seeing it as a waste of time and pawning her off to daycare, I'm learning to find joy in the everyday tasks because maybe this is the life I have been working so freaking hard to build. Because, dude, I've always wanted a baby to spit up on my shirt and urinate on me. That was always my dream. It's the best. Nah, but jokes aside, please do something this weekend. Do something that gives you peace or fulfillment while at the same time prioritizing your future and your goals. Just enjoy yourself a little bit. Life's not that serious. Choose peace, okay? I love you guys. Stay safe. Good luck in the stock market, and let me know if you have any questions or feedback or commentary. I'll talk to you guys really soon. See ya.